Thanks for tuning in the video blog today. Today, we're going to talk about our outlook for 2025. Stick around, we'll be right back. So today is January 10th, 2025, and last night Notre Dame beat Penn State to advance to the college football championship game. And tonight, UT is going to take on Ohio State for the right to play Notre Dame in the championship game. The college football playoffs, they included 12 teams this year, and all 5 automatic berth teams are now out, including the top 2 ranked teams, Georgia and Oregon. Georgia's out, so sorry, Claire and Lauren, but it wasn't supposed to turn out this way. And the debate about why it did is just about going to get started here. So if you think forecasting college football is hard, try forecasting the economy, stock market, and elections. Not one Wall Street firm came close to predicting the level of the S&P 500 on the close of December 31st, 2024. They were all too low. Inflation stopped improving too, and the Fed had to shift its forecast for rate cuts for 2025, taking it from a total of 1 percentage point rate cut to about half that. And don't forget that most presidential election forecasts missed a shift in nearly every demographic group also. All this makes forecasting 2025 yet another significant challenge. So the U.S. has run nearly $2 trillion in budget deficits in each of the past 2 years, and half of all of job growth in the past 2 years has been in government and healthcare jobs, not to mention that the growth in the money supply has been trending higher also. At the same time, the new Trump administration wants to cut spending by up to $2 trillion, push for an extension of the 2017 tax cuts, and possibly cut other tax rates as well. We've also got tariffs in the picture, a significant slowdown in immigration and deportations of some immigrants who are already here, and all of this follows some of the most dramatic policies in U.S. history. We've always thought that the COVID lockdowns were a huge negative to growth. And the massive government spending, along with the largest surge in the U.S. money supply in the country, pushed GDP back up to levels of its previous levels. So GDP went back up as we inserted a bunch of money into the economy. So all of the massive stimulus helped keep GDP where it was. That stimulus masked the pain, like morphine. So what's morphine do? It just delays the pain. We have always believed that the stimulus morphine just delayed the pain, and a recession was inevitable once it wore off. So once the morphine goes away, the stimulus goes away, then a recession was inevitable. The pain will come on. But the U.S. is hooked on morphine. If Trump and Doge cut the deficit, the morphine is going to wear off. And with significantly less stimulus, a recession becomes more likely. Not a deep recession, but one that causes real GDP to decline about 0.5 to 1 percentage point, and corporate profits to disappoint really for the first time in years. So while there are many positive things happening, this new world order is still a little uncertain. Less regulation is great for growth, but reduced deficits serve as a short-term headwind. In the long run, just like under Reagan, smaller, less intrusive government policies can be a massive positive. But the P/E ratio on the S&P 500 is much higher today than it was in 1981. So unless the Trump policies lift productivity, growth, and profits immediately while reducing inflation, the stock market doesn't have nearly the same upside that it did in the early 80s or even the past few years. So if you're one of our clients, we've already taken steps to help position your portfolio to better weather whatever storm may or may not come our way. If you're not one of our clients, we highly encourage you to reach out to your own financial advisor to have a discussion about current economic backdrop and your portfolio positioning. Of course, if you'd like a second opinion, please don't hesitate to reach out. We'd be happy to talk. Remember, stay the course and hook 'em horns.